All right, another record high yesterday, but looking a little bit lackluster day. Only 6,030 on S&P futures. 30 minutes till the cash trade. I'm Matt Miller.
I'm Sonali Basak.
And I'm Katie Greifeld. Bloomberg Open Interest starts right now.
Coming up, the Trump rally finds gravity. Stocks pausing gains while Bitcoin nears 90,000.
And Elliott strikes again. The activist investor is said to have built a $5 billion stake in industrials conglomerate Honeywell.
Plus, a check on the consumer with Home Depot raising its outlook as seasonal spending picks up. All of that and more coming up. But let's take a look at these lackluster markets, as Matt Miller called them. Lackluster is right. You have the S&P 500 right now poised to snap a 5-day rally. It did manage to finish in the green yesterday, but just barely. Pretty quiet, though. You can go ahead and call the big tech index, the NASDAQ 100, unchanged. In the bond market, it's open again and it's selling off. 10-year Treasury yields higher by about 8 basis points right now. We are nearing, once again, on 440. Matt Miller.
Suffice it to say, we're at all-time highs on stocks, and we're at real tights on investment-grade credit spreads. Take a look at this chart going all the way back to 1997. That was the last time we saw spreads this tight. Right now, just 0.74% away from treasuries. And with spreads this tight and valuations this high, it makes you wonder if something could go wrong.
You have to bank on higher yields alone, Matthew. Let's take a look at some stocks moving here under the surface. We're looking at e-commerce giant Shopify surging. Revenue topped analyst estimates. The free cash flow margin also expanded. Shopify now up more than 22%. You also have Home Depot showing some green when it comes to the consumer, up about 1.7% pre-market. The forecast is higher on renewed demand for do-it-yourself materials. This is the big story of the day. Activist investor Elliott has built a $5 billion stake in Honeywell, according to sources telling Bloomberg. It is the largest investment by Elliott in a single stock. The activist investor is pushing for a breakup. Honeywell is up almost 7% pre-market, Matt.
Yeah, but Honeywell's up only 7% this year to date. Honeywell's up only 25% over the last 5 years, while the S&P 500 has tripled, right? The industrials index is up, I think, 75% or something like that. So Honeywell, something needs to change at this conglomerate. And there aren't many giant industrials conglomerates left.
That's the thing. It really feels like the era of the conglomerate is over. We've known that for a while, but this story, a real sign of the time. And when it comes to these activist investors, spinoffs are really popular, and they've been very well received by the market. Bloomberg actually has a spinoff index, some of these recent spinoffs. It's at an all-time high, as you can see right now, up over 165% over the past 5 years. So it makes sense why Elliott in particular is reportedly taking this route.
What's interesting about it, too, is you recently have had Honeywell do large deals, so potentially an unraveling even after you saw them buy Carrier security unit, Air Products unit here as well when it comes to liquefied natural gas. They have been a buyer of things spun off of other businesses.
That said, it did announce last month that it's spinning off its aerospace, it's spinning off its advanced materials division. So it has tried to streamline a little bit.
It sounds like a 60s company, right? They have advanced materials, they have aerospace, they have industrial automation.
Yeah, it's something that would the men in Mad Men would advertise for.
I will quickly say, too, this all gets more heated when you think about how much M&A is expected next year with the lack of regulatory oversight expected under the Trump administration.
Hey, did you read the Chris Hughes column? Because
the guy who thinks
the contrarian
don't be so
column.
sure.
The contrarian column.
Let's bring in BNY Wealth CIO Sinead Colton Grant. She joins us on a day when maybe we're going to pause the incredible rally that we've seen, but it has been insane. I mean, S&P 6,000 is here already, and a lot of strategists don't have that penciled in for year-end 2025. So what's your take on the broader market?
Well, first of all, it's not about today. It's not about yesterday. It's about where we go over the next 12 months. We know stocks react to earnings and interest rates. It's always about the fundamentals. And one of the reasons why we've seen such a strong reaction in the equity market has been because the expectation is less regulation, We'll see earnings improvement. We'll see a bigger boost to the economy. And that's all extremely positive. And by the way, we didn't have 6,000 penciled in, but we were close to the top of the range at 5,800, and we are looking for 6,300 next year.
What role does interest rates play here? We were talking a little earlier, Katie mentioned you have the 10-year getting back towards that 440 level. At what point does that start to hurt what you're seeing in the exuberance in the stock market?
And that's the interest rate component, right? So I think what's been very interesting since we had the election results last week was just how the bond market has reacted. And it feels a little bit more like the equity market reaction following the 2016 result. There's an initial knee-jerk concern this time about the debt, the deficit, and what that's going to do to interest rates. It's probably a little short-sighted in my view, because it is highly unlikely that we're going to see the Trump administration adopt policies that become very inflationary, because if you look at what all of the results are telling us, it was the hurt that consumers were feeling from cumulative interest rate or cumulative inflation rises and interest rate increases that really swayed their view on the economy and led to the Trump victory. So I think the bond market is overreacting at this point. Now, yes, debt levels are high. The level of government debt at about 100% is very high. We do need to be cognizant of a high deficit at a time that we're not in recession. But it's too early to really make a conclusion from that in the bond market.
So the bond market overreacting. Let's talk about whether or not stock investors are overreacting. There were some great sell-side notes out this morning. You had Bank of America in their fund manager survey finding that U.S. equity exposure is at an 11-year high. You had Citi building on that, saying that positioning is at a 3-year high. And they went further and said that actually you're going to see people take some profit here, and we could see a cool down right now. When you take a look at your various positioning metrics, where does that leave you on some of these technical forces?
We've been overweight U.S. large cap for the last 18 months, and that's performed very well for our clients. But look, some consolidation at these levels would be healthy, but the underlying fundamentals are strong. So we're expecting earnings growth of just under 9% for 2024, just under 15% for 2025. Those are very robust numbers, and they'll really underpin the market going forward. Now, when we look at tech relative to the valuation of the rest of the market, we don't think it looks overvalued. In fact, it's a sector that we quite like.
I was reading one of the notes, Katie is talking about the Bank of America note, and I was struck by the prediction of no landing. I think we have the note that Michael Hartnett and his team say post-election results show higher global and U.S. growth expectations, higher inflation expectations, lower probability of a soft landing. And I translate that into no landing, right? Because we're still inflated, we're still elevated. What do you think about the inflation risk?
Well, first of all, I think it's hard to talk about no landing because it will be a soft landing, even if it's the softest of soft landings. When we think about growth for 25, we're expecting that growth in the first half is a little bit slower, and then it reaccelerates in the second half in order to, as you really see the impact of those rate cuts from the Fed coming through. Look, inflation, we've got a print tomorrow. We're already seeing headline at 2.4%. Expectations are that it moves up a little bit. But here's the thing. The Fed tells us constantly that they are going to be data dependent. So that's interest rates, that's the unemployment rate. And what we're really looking for tomorrow in that inflation print is the shelter number. We want to see that continue to move lower because it's the stickiest component. It accounts for about 40% of the index. And we're expecting to see continued progress on inflation. Now, may it settle at a slightly higher level than we saw post the financial crisis, maybe in the 2.5 to 3% range longer term? That's entirely possible, but those are not problematic levels of inflation, and equity markets have done incredibly well at those levels.
Right. Well, Sinead, what do you see as the driver from here? Do you think it's going to be the economy? Do you think that there's more room to run in this political trade? Do you think it's going to be earnings, which have been a little bit lackluster? Or could it be positioning, the fact that seems to be out there that this is a stock market that maybe is over-allocated?
Well, let's take a step back for the moment. If you don't allocate to U.S. stocks, where do you go? Do you look outside the U.S.? And then you need to think about cumulative GDP growth since 2020. Here in the US, it's been over 11%. You go to the Eurozone, that's the next best, by the way, it's under 5%. You go to Japan, the UK, it's 3% or lower. And so I think in answering that question, it's really important to take account of the broader economic drivers. So the US economy is, we expect, going to continue its leadership of the global economy. When you look at the innovation that is inherent within the S&P 500, the components of tech, communication services, and now when we think about AI and productivity gains, that is really positive for U.S. stocks and particularly for large caps.
All right, Sinead, that's a good place to leave it. Really appreciate you taking the time this morning. That is Sinead Colton Grant of BNY Wealth. It's a very quiet morning on the index level. Let's see if we can find some action under the hood. We'll do that with Abigail Doolittle.
Well, beneath the surface, Katie, we have the shares of Hertz plunging down 6.5%, or down sharply, I should say. This after they missed estimates in a significant way. The revenue estimate they missed, plus down about 5% year over year. They put up a much bigger loss of 68 cents versus the estimate for a 48-cent loss. They, in addition, took a $1 billion impairment charge. Now, into today, the stock down nearly 70%, adding some heft to that. And there is a stunning 39% bearish short interest on this stock. So a lot of investors out there interested in Hertz, not so surprised by these results. Speaking of short interest, but going in the other direction, Live Nation, some of this gain on the day, up 6.4%, could have to do with a short squeeze. There's an 8% bearish short interest there. They put up a third quarter adjusted operating income that was better than estimated. In fact, Jeffrey saying that it carried the day. And then finally, that Trump trade, the crypto piece of it. Today, a little bit of softness to that. We do have Bitcoin and some of the other coins coming off of record highs. And as a result, many of the names associated with that crypto trade, well, they're down today in the pre-market, down 3.8%. But it's been a pretty stunning rally into today. Some profits being taken off the table. Sonali.
Yeah, seriously stunning 7-day rise. A little of a breather now. Abigail Doolittle, we thank you for your time. Now coming up, bonuses set to grow on Wall Street for the first time in 3 years. More on that next. This is Bloomberg.
Let's get now to high interest, a look at what's making headlines around the world. Analysts say China is likely to embrace more stimulus, boost its manufacturing, and allow its currency to weaken as a way to offset the negative effects of a second Trump presidency. The president-elect has threatened 60% tariffs on Chinese goods that could decimate U.S.-China trade and hurt exports that have been a rare bright spot for China this year. Meanwhile, Donald Trump is expected to elevate a pair of China hawks in a sign that U.S.-China relations may deteriorate further in the years ahead. Florida Senator Marco Rubio and Representative Mike Waltz are set to be named Secretary of State and National Security Advisor, respectively. Rubio has been sanctioned by Beijing, while Waltz has declared that the U.S. is in a Cold War with China. And Wall Street bonuses are expected to climb across almost all sectors of the industry for the first time in 3 years. That's according to a new report from compensation consultant Johnson Associates. Investment bankers, traders, and asset and wealth management professionals are all set for double-digit increases in year-end incentive pay. Bankers who help companies sell debt might realize the biggest gains, with payouts set to rise as much as 35%. Sonali?
Seriously large boom here you have seen in debt underwriting, and of course those bankers ready to get paid out, Matt. But we're going to switch gears. We're going to talk about Main Street a little more, because Home Depot lifted the forecast for the year as demand for do-it-yourself materials was driven higher, but it was driven higher by bad weather. Bloomberg intelligence analyst Drew Reading has the details. And one thing that really struck me was the expectation moving forward, this kind of reliance, if you will, Drew, on this idea that mortgage rates need to get back down to at least 6% to see a bigger tail end here. How do you think investors read that, given how much volatility that there has been in interest rates?
Yeah, housing is certainly a big component of the Home Depot story, and the volatility in rates, I think, has held a lot of people back. We saw rates come down to the 6% range in September. We saw a corresponding improvement in housing demand, but in just a matter of weeks, we were up 90 basis points, even after the Fed cut. And now we're hovering around 7%. So that continues to put home ownership out of reach for many. So you have the housing component on one hand, but on the other hand, I still think Home Depot is partly just a broader macro story. You have consumers who have been under pressure by the cumulative impact of inflation and still that just general broader sense of economic uncertainty. So we've seen consumers pause. We've seen a slowdown in big ticket discretionary spending. So we think that's kind of on a relative basis where Home Depot is seeing the weakness.
And with that being said, that this is a macro story, broad brushstrokes, what does that portend for Lowe's, Walmart, Target, who we're also waiting for in the coming weeks?
Yeah, so I think the home improvement retailers are in a little bit of a different position. Their consumers tend to be a little bit higher end, as you would expect. The majority are homeowners. They tend to have higher incomes. And I think while the business has certainly slowed, overall spending has held up pretty well. And I think a lot of that has to do with the wealth effect, not only from rising home prices, which have built homeowners' equity, but also the equity portfolios. The stock market gains have kind of kept spending going in this segment of the market compared to some others. And we've heard from a handful of the suppliers that there has been a trade down. So you're seeing some of the higher end products outperform the lower end.
What's your outlook, Drew, for the housing market in a broader sense, especially as we get a new president coming in? We don't expect to see, obviously, the Harris plan to build, what does she want to build, 300,000?
3 million.
3 million new homes. But we did hear that Trump wants to goose the market some. I mean, what are people in the industry talking about?
Yeah, so a lot of the proposals we heard from the administration gear more towards that new residential construction side. We think that the existing home market's going to have a tough time getting back to normalized levels with interest rates 6.5% to 7%. The other thing you have to consider is when you look at broader affordability, it's not just rates. Sure, they get all of the attention, but home prices are up more than 50% since pre-pandemic levels. We did an analysis recently that showed that property values would have to fall about 30% for monthly payments relative to incomes to get in line with historical averages. Now, we're not saying that that's going to happen at the national level, but there's different pockets across the country. So, the housing affordability equation is complex, and it's not just about rates. That being said, when you talk about the home improvement retailers like a Home Depot and a Lowe's, what you have to remember is that while from an absolute volume perspective, things may not be back off to the races, we've been hovering at these depressed levels for, the better part of 2 years now. So the comparisons for them do start to get easier. We do think you could see some growth, albeit off a very low base.
Andrew, something that we're asking about all retail names is what's the potential impact of tariffs, of course, as Donald Trump returns to the White House? My understanding is that Home Depot sources most of its goods domestically, but how are you thinking about tariffs when you're analyzing some of these names?
Yeah, great question. And there's still a lot we don't know, but Home Depot is one of the largest importers just based on their scale. But like you mentioned, their exposure to China is probably less than what you'd think, probably just inching up into the double-digit range. As you said, they do source a majority of their products that they sell through North America channels. So when you compare them to some of the other retailers, maybe like apparel, footwear, or home furnishings, the impact is certainly going to be less.
Or Amazon.
Exactly. You could see some pressure on the gross margin side. But like I mentioned, I think it's muted compared to what we're going to see from some other retailers.
True. One reason we're watching Home Depot today is, of course, that health of the consumer, the housing market. But it is really the first of the big box retailers to be reporting. What do you expect out of Lowe's and Walmart?
Yeah, so I expect really more of the same out of Lowe's. And that's really that the market for big ticket discretionary items is likely to remain weak. And this plays across the retail space where you just have, in general, a more cautious consumer who's putting off that kind of purchase. They tend to be tackling smaller scale projects or doing things in piecemeal rather than, taking on those big ticket projects that need to be debt financed. And that's really one of the areas that Home Depot and Lowe's have called out over the last several quarters, things like kitchen and bath, where interest rates are really having an impact on consumers' ability to finance those projects.
All right, Drew, great to get some time with you. Really appreciate it. That is Drew Redding of Bloomberg Intelligence. Meanwhile, we are less than 10 minutes away from those opening bells. More market coverage ahead. This is Bloomberg. All right, let's take a look at futures right now. We have 6 minutes to go until the bells ring, and maybe that'll introduce some action into this market because at least on the index level, it's pretty quiet. You have the S&P 500 in the futures market down a little bit, big tech as well. Even the Russell 2000, of course, those small caps have been your leader, but not anymore, at least for today. The Russell 2000 currently off by about 0.6%. It's possible that people are taking profit here. That's what Citi said is going to happen here because you have a lot of people coming back into this market. Bank of America out with that note, of course, that positioning is at an 11-year high. And guys, I wonder, it gets back to some of those things we were talking about with the household surveys, basically that everyone's already in this market. Who's the marginal buyer? And maybe it is time to just lock in some gains.
Yeah, I think Cole Smead has come on and talked about the St. Louis Fed that looks into how much households are invested in stocks, and they found that right now it's the most ever since they began keeping data in the 1950s. So we're definitely fully positioned here, no matter what index or proprietary algorithm you look at.
Right.
Citi, it's
we're
just
holding,
a 3-year high.
we're heavy on stocks. Yeah.
Leverage is also near all-time highs for big institutional investors. And you look at where we are in the rest of the year. You have a few more earnings left, a few more weeks of earnings, I suppose. But really the last catalyst was the election. We have that drip drab of political appointments coming out. Maybe less regulatory bent in the government would help unlock some of these sectors. I'm looking at banks today because you really only still have the yield curve at a disinversion of about 5 basis points. Even
That's why you're looking at banks today?
Well, oh yeah,
You're looking at banks every day, Sonali.
Well, today in particular, we're interviewing Jane Fraser at 2 o'clock. So
yes,
that is
that
to be a
will be interesting.
Insight into how the banking sector will perform.
All right, catch that interview at 2 p.m. And coming up on this program with less than 4 minutes to go, we'll talk with UBS Global Wealth. This is Bloomberg.
We are moments away from the start of trading after yet another record high on stocks yesterday. Currently, doesn't look like we're going to be repeating that, but I mean, who knows? We're basically unchanged right now in terms of S&P futures, NASDAQ futures as well. Russell 2000 down a little bit, but as Sonali has been pointing out, we're getting, I think, a little bit heavier than a drip feed in terms of information on who is going to fill Donald Trump's cabinet. And that may spur investors to jump in even more, to the extent that they still have any cash. I think appropriate to the Trump win, you have the UFC ringing the bell at the New York Stock Exchange. That tracks. Cirrus Logic at the NASDAQ, I believe it's been 35 years since they've been listed on that tech-heavy index. Let's get a check at the major averages right now, even though, KD, I think right now doesn't determine what we're going to see at the closing bell. It's just a blank canvas. It's just a platform from which we take off, right?
You are so right, Matt Miller. Anything can happen between now and 4 p.m. today, but at least for right now, it's crickets. You have the S&P 500 a little bit higher. That's all you need for all-time highs, but pretty tepid gains right now on your big benchmark. Big tech kind of deciding what to do. The NASDAQ 100 currently flat on the day. It's been bouncing back and forth, but then you have the small caps, and they are firmly lower right now. On the Russell 2000, down about 0.6%. This has been your winner, so maybe investors taking profits here. But let's dial down into some specific earnings because we've been talking about Home Depot all morning. Of course, it raised its forecast as extreme weather boosts demand for DIY materials. You can see shares higher by about 1.2%, and this is a stock that's been faring okay. It's up 20% year to date, lagging slightly, but still faring better than some.
Katie, I'm keeping an eye over here on that Honeywell story, also up on the day, up about 6%. Activist investor Elliott has built its largest ever stake in a single company at $5 billion in Honeywell, according to sources who told Bloomberg. Honeywell is climbing now by the most in 4 years, Matt.
Yeah, that makes sense. It hasn't had really a great 4 years. Let's talk about the Canadian e-commerce giant Shopify, because apparently so many people on the staff get stuff from there. It reported third quarter revenue that came in ahead of estimates. Shares are surging the most since August. did we confirm, do they trade here in the U.S., Shopify, or is that like the Toronto
It's definitely a
stock
Canadian
exchange
company.
Okay, so yeah, no, apparently the shares trade here as well, and they're up 21%. I mean, that is massive. That is a huge jump for a Canadian company. Let's take a look, though, back here in America. Refocus on the Trump trade. For that, we bring in Bloomberg's Abigail Doolittle. Abby, what do you see today?
Well, after the best 5 days for the S&P 500 in a year, right now we have that S&P 500 flipping between very small gains and losses. If higher again, it will be yet another record high, and it was higher a moment ago. So I believe that would be an all-time high, although don't quote me on that for sure. In any case, if the S&P 500 were to flip higher, that would be a 6th up day in a row, so that long streak. But you can see pieces of the Trump trade taking a breather today. DJT, Trump Media and Entertainment, and then, of course, Tesla, which was up some 30 to 40% over the last 5 days into today. Elon Musk, of course, a big piece of the Trump campaign and potentially some piece of the administration, although we, of course, have not heard that yet. As for the piece of the Trump trade that's been capturing everyone's attention recently, that is the crypto trade. But today, a little bit of a breather after Bitcoin was above $87,000 per Bitcoin. We now have it cooling off just a little bit. This is true, too, for Ether. And then some of these stocks, Mara Holdings yesterday, I believe, was up 29% today, giving some of that back. Riot Platform giving much of it back, down 9.2%. But again, in the context of big double-digit gains in just 5 days. When we put it into the context of the chart, this is interesting because these technicals have been calling for Bitcoin to come back down to its long-term uptrend consolidation as has happened in the past. But instead of doing that here, it looks like we might be doing something more similar to out of the 2020 election, where we're going to stay elevated for longer. And you can see today's decline. Well, Katie, it's not even registering in the RSI. It is still overbought and going higher, suggesting that the Bitcoin buyers, well, they're just taking a breather today. They may be back pretty soon.
All right, Abigail Doolittle, thank you so much. All those Trump trades taking a bit of a breather, but as you say, just a blip on the longer term charts right now. Let's keep the conversation going with UBS Global Wealth Head of U.S. Equities, David Lefkowitz, joining us now. And I want to talk about positioning. You have Citi saying that positioning is at a 3-year high. Bank of America says actually it's at an 11-year high. This is a fully allocated market. And yet you have more than $6 trillion in money market funds. David, what do you make of the state of play on positioning, and how does it factor into the road ahead?
Yeah, thanks for having me, Katie. So, yeah, I think there's been no doubt that we've seen an increase in positioning, not surprising given the pretty strong moves in certain segments of the market that we've seen since the election. But, positioning is just one part of the puzzle here. And the election result notwithstanding, we had some pretty strong drivers for this equity bull market, and we think those are still in place. We've got durable economic growth, healthy profit growth, the Fed cutting rates, and a boom in AI. And some of the pro-growth aspects of a potential Trump administration just reinforce some of those positive elements. So, yeah, look, I mean, we know stocks don't move in a straight line. Indices can be volatile. But in our view, the fundamentals and the drivers of this equity bull market still remain very firmly in place.
It's interesting because you do see the S&P 500, of course, just having a banner year, and you haven't really seen since the 90s a double 2 years in a row of 20% or more increases in the S&P 500. I know that UBS's target is really 6,600 when you look through the end of next year, but what is the potential here for the rate of acceleration, right? Trump was elected president. You saw the Trump trade. He is setting up his staff around him. And the question to me is, do the policies that they put in place drive the market higher than the rate you're seeing the market rise now?
Yeah, I think it's a great question, Sonali. So I think there's still a lot we don't know about the new Trump policies. And I think it's going to be important to draw a distinction from what we saw in Trump 1.0. Trump 1.0, we saw a very substantial reduction in the corporate tax rate. Obviously, Trump wants to reduce the tax rate further, but budgetary issues are probably going to make that challenging. So there certainly will be a much smaller, if there even is, a reduction in the corporate rate, because extending the personal income tax cuts, which expire, that's going to be very expensive to do, probably somewhere in the $4 trillion range over the next 10 years. So I think the Trump trade and the Trump policies, they have potentially echoes of what we saw in 2016, 2017, but those echoes are probably a little bit smaller, and we haven't even talked about the tariffs. And clearly Trump, wants to pursue tariffs. That seems to be a core part of his belief. Robert Lighthizer potentially being appointed as U.S. trade representative. He's been a pretty hardliner. There's definitely more. I would say there's more cross currents in this potential Trump administration than what we saw, back at the first time.
If we do have big tariffs and mass deportations, we're also excited about the market. I think that we may overlook the potential for inflation to come back. Or is that just crushed? Is it just not a possibility that, shifting out 10 million workers and raising tariffs to 60% on China brings inflation back?
Yeah, Matt, I mean, some of these policies, would be inflationary. I think the question really is, what is ultimately implemented? And I think that's sort of a broader question across all of the policies. It seems like right now, the market, we're almost in sort of a honeymoon phase when, investors almost feel like we're kind of a kid in the candy store. But I do think the reality of getting how all these policies fit together, that's going to take some digestion on the part of investors as we go into 25. But, in the more likely outcomes, Matt, I don't think we're going to be talking about a substantial change in the inflation outlook. Imported goods, let's not forget it. It's not a huge part of the economy. Just goods in general are only about.
But worker pay is, David. I just can't imagine if you take out multiple millions of workers that you don't get the labor market tightening up substantially.
Yeah, look, I don't disagree. I think the question is, what ultimately will be implemented and over what time horizon. Mm-hmm. But yeah, if we get a tightening of the labor market, certainly that could be a source of inflation. I would also let's remind ourselves, what really caused the inflation spike in the COVID period. A lot of it was related to COVID and the supply chain issues that we saw and this massive surge in goods consumption that the supply chain just couldn't handle. So I think any inflation firming is going to be very different than what we lived through a couple of years ago.
David, we thank you so much for joining us today. A lot to still digest. That is David Lefkowitz of UBS Global Wealth. Now coming up, we're going to bring you more on that Bloomberg scoop that activist firm Elliott is pushing for a breakup of Honeywell. A couple tough years, as Matt has been talking about, but now we're seeing a rise on the prospect of change. This is Bloomberg.
All right, it's time now for our top calls. Some of the analyst action in focus this morning. And first up, Phillips Securities cutting Airbnb to a sell. The firm says that the stock's valuation remains expensive and that it trades at a premium compared to rivals such as Expedia. Next up, Carter's no longer a sell. That is according to Citi. The firm is raising its rating on the children's apparel company to a neutral, saying that the risk reward is more balanced following the stock's recent slump. And finally, we have Morgan Stanley upgrading Viking Holdings to a buy. The analyst says that demand for cruises remains robust and that falling oil prices help too. The company reports next week, Matt.
I'm looking forward to that. Have you been on a cruise before, Katie?
No, I fear the ocean and rivers.
All right, very interesting stuff. I can't wait to talk about the cruisers when they report. Now, Bloomberg has learned that activist investor Elliott is taking a more than $5 billion stake in Honeywell. That would be the biggest investment Elliott has ever made. And it is pushing for the industrials giant to break up into two standalone companies, at least. Bloomberg's Brooke Sutherland helped to break this story. She joins us now. And Brooke, I find this a fascinating scoop. It's obviously moved the market significantly. What do they want to do with Honeywell? And are the leaders of that company receptive to Elliott's suggestions?
So they do have a new CEO at Honeywell. Vimal Kapoor has been there for a little over a year now, and he has been saying things about wanting to remake Honeywell's portfolio. They are spinning off an advanced materials business, but this remains a very complex company, especially in this day and age when we've seen so many breakups among the great industrial conglomerates of the past. Honeywell is really one of the few that has retained the sheer breadth of businesses that it has. It makes automation equipment, it makes warehouse robots, it makes parts for airplanes, it makes different additive materials. It's a very complicated company. And I think what's important to remember here is that there's nothing fundamentally wrong with Honeywell. It's actually a very, very well-known company, and it's known for being extremely efficient, but it's just so complex that it's really struggled to grow and gain attention with investors. And that's really what Elliott is focusing on here, that this is a company that's too complicated for its own good, and potentially taking that very valuable aerospace business and making that a standalone could create a lot of value.
Brooke, one line in this story really strikes me, and it's what they get out of the sum of the parts. The idea that you could have a share price upside of 51 to 75% over the next 2 years. What do we know, especially because there's a somewhat newer CEO in line here? How are they receptive, if at all, to Elliott's proposals?
Well, I think that some of the parts is really interesting, and you just have to look at some of the breakups that have happened recently, and particularly GE. That company did a three-way split. They did it in pieces. They spun off their healthcare business, and then earlier this year, their energy business. And I don't think even the best case scenarios that analysts could come up with could have envisioned the just rocket ship that GE stock price has been on since they announced this breakup. And their spinoffs have done fairly well too. GE Vernova, last time I checked, was the best performing stock among industrials on the S&P 500. And so I think when you look at that, that just shows you the value that can be created when you untangle these very complicated conglomerates. Because again, these are fundamentally very good businesses. It's just whether or not you can appreciate that when they're all shackled together. They tend to grow at different rates. They tend to have different capital requirements. They have different M&A needs. And investors don't think like that. They want to look at a very simplified story, and it's harder to get them motivated to invest in something complicated when there are more simple stories out there, like GE Aerospace, like, in the aerospace sector, like Howmet, like TransDigm. You just look at how well those stocks have been performing relative to Honeywell. Right. And I think that shows you what Elliott is really focusing on here.
Well, Brooke, we were talking about it at the top of the hour that spinoffs have been so high. You take a look at Bloomberg's spinoff index, it's at an all-time high. And to your point, the top holding in that index is GE Vernova, followed shortly by GE Healthcare and Constellation Energy. I'm curious, though, you've been covering industrials for so long. Do you think that we reach a tipping point where the cycle turns around and maybe we do enter an era where industrial conglomerates make sense?
Sure. So, I do think that we had a moment in time where maybe the industrial spinoffs went a little bit too far, and we were splitting hairs, and we were talking about, breaking up pump makers and separating out life sciences pumps from oil and gas pumps and things like that. And I think that didn't necessarily create a lot of value. That's not what we're talking about with Honeywell here. But you have seen, a bit of a shift in industrials in terms of at least looking for more balance, maybe not being so narrowly focused that their business is vulnerable to volatility in markets. And so what that means is maybe you don't just have an aerospace company, maybe you have an aerospace and defense company, or maybe you invest further down or further up in the supply chain, whatever that might look like for a specific company. You think about a company like Nucor, for example. They're a steel maker. They bought a garage door company a few years ago in terms of just trying to create more of a balance, less volatility in their earnings. And so I think you will continue to see more of that, but I don't think we're going back into the conglomerate structures of old where you had seemingly much more random configurations of businesses. I think that age is ending, as you see here with Elliott making this move at Honeywell today.
Brooke, we're so grateful for your time. Great scoop. Of course, Honeywell moving on the news. Bloomberg's Brooke Sutherland, who knows everything about this space, really. Now, coming up, Donald Trump Jr. opts out of the White House and hops into the world of venture capital. We're going to talk about what he's looking at next in today's Wall Street Beat. This is Bloomberg.
Welcome back to Bloomberg Open Interest. Let's take a check on the stock market. About 22 minutes into this Tuesday trading session, you can see the S&P 500. The color is green, which means that we're at all-time highs, but really tepid gains here, just up about 0.1% on the S&P 500, on the NASDAQ 100 as well. Even the Russell 2000 coming back from some of its steeper losses. It was down about 0.6%. It's still in the red, but those small caps only down about 0.1% at the moment, Sonali.
And Katie, it's time now for the Wall Street Beat. Today, we're looking at Donald Trump Jr.'s jump into the world of venture capital. The president-elect's oldest son is set to join 1789 Capital, which is a venture capital firm that invests in conservative-leaning companies. Joining us on the phone now with more is Bloomberg Wealth's Amanda Gordon, who's in Palm Beach, Florida, reporting on the latest in the Trump transition. And it's really interesting. He's not the only one in the Trump family orbit who has gone into investing, but we know that Donald Trump Jr. in the past has played a very critical role next to his father in the world of politics. Amanda, explain the move here.
Well, one of the things that Donald Trump Jr. did during this campaign season is be really out there doing podcasts, making speeches, connecting with a really younger donor with a hook to Silicon Valley and the tech scene. And so it feels like a natural evolution if you've been following him, if you saw him, as I did, on the final night of the Republican National Convention, presiding at a booth in a room filled with investors from Founders Fund and the whole scene there. David Sachs saddled up to the booth at one point. So this seems like a natural step, and I think it's just worth saying that while right now we as journalists are focused on who will be staffing inside the White House, this movement also creates a lot of market opportunities. America has just given us a signal of where consumers are moving, what they're thinking, what they want to consume and read, and the American products they want to buy. And that's where Omid Malik, who runs the firm, and where his friend Don Trump Jr. will be focusing.
Yeah, I mean, it's also fantastic if your dad is the president to be able to help these companies thrive and grow, right? It just gives you a huge leg up. So do you know what kind of companies he's going to be investing in?
Well, media has been one area that the firm has already dabbled in, making an investment in Tucker Carlson's concern. And also, as I signaled, products that are made in America is an area of interest. So these things are happening, as we speak. There are rooms where there are interviews for posts like Treasury, and there are rooms in Las Vegas right now where people are pitching. Don Trump Jr. made his announcement at a conference organized by the Rockbridge Group, which is conservative-leaning donors, and he made this move. And I think because he's already such a public figure, he's going to naturally attract interest and opportunities. They're going to come to his door.
All right, Amanda, thanks very much. Amanda Gordon there reporting from Palm Beach, Florida. And I imagine 1789 is not a reference to the French Revolution, as you would instantly think, right? But to the election of George Washington and the adoption of the Constitution.
That's probably fair.
Yeah.
Really interesting to see this move by Don Jr. But of course, all eyes trained on when we're going to get the Treasury Secretary pick. We were talking yesterday about how Scott Bessent is leading in the betting markets. Of course, this all comes up to one man, but you're seeing plenty of key advisors to Trump also back Bessent as well. So maybe a decision coming in the next couple days.
Well, that would be the biggest deal here, too, because you know that he has been so close to him when it came to the Economic Club of New York speech. I know you and I were both there. Critical person behind his policy. Let's see how the market takes it, Matt.
All right, don't miss, by the way, later today, Sonali's exclusive interview with the CEO of Citi, Jane Fraser. That's at 2 p.m. Eastern. We are 30 minutes into the trading day. Welcome to Bloomberg Open Interest. I'm Matt Miller.
I'm Sonali Basak.
And I'm Katie Greifeld.
And coming up, the Trump rally finds some gravity as the president-elect fills his cabinet.
Howard Lutnick raises his hand to run Trump's economy as key advisors back Scott Bessent for Treasury Secretary.
Plus, a retailer on the rise. Home Depot lifts its forecast as seasonal spending picks up. We'll discuss all of that and more, but let's get a check on these markets right now. 30 minutes into the cash session, you can see the S&P 500 a little bit higher, and I stress a little bit, just 0.1% higher on the S&P 500 as we hover at all-time highs. Similar story if you take a look at big tech, the NASDAQ 100 higher about 0.1% as well. And then you take a look at the bond market. Of course, it was closed yesterday, a little bit of a break, but now we're back in sell-off mode. Yields climbing on the 10-year Treasury yield, higher by about 6 basis points at the moment. We are at 4.36, Matt.
Still not shockingly high, right? You feel like the bond vigilantes who peaked out.
Did you see Nouriel Roubini was on Bloomberg TV overnight saying that they could come back, but
They're on standby.
I think they're all retired.
What do you make of these rates, Sonali? I mean, the run up and then back down ends up to be nothing after last week.
In the commercial break, you got an email from TD Bank saying they exited their 530 steepener, and it's kind of that crowd coming back that says, okay, we positioned one way, maybe some of this has run out already. It's fast to run out.
Yeah. All right. Let's talk about this right now with Emily Leveille. She is a portfolio manager and managing director at Thornburg, normally out west. She joins us here today. Great to have you in New York in the studio.
Good morning. Nice to be here.
I mean, what an insane time in markets, right? Over 6,000 on the S&P. Corporate spreads are at record tights. The economy looks fantastic. 3% GDP growth. Inflation's coming back down. Unemployment's only 4%. Is there anything bad right now? Is it all good?
It's certainly, I think, better than we thought it was going to be at this point at the beginning of the year. But I do think that the recent run-up in the last week imputes a lot of really good news. And I do think there are risks on the horizon. I mean, I think, we're getting early signs of who Trump wants to appoint in the administration. I think that we could see, more of this concern around inflation starting to come back, especially as we go into the beginning of next year. So the end of this year, I think the stock market can probably run. But as we get more details on sort of what areas the Trump administration is going to focus on, I think the market could start to get a little concerned again. So I think we're priced for a Goldilocks scenario, but there are some clouds on the horizon that I think as investors we want to be concerned about.
Well, how do you actually position for some of those risks that you name? Are you putting on hedges, spending money to do that? Are you just overweighting certain sectors, underweighting others? What does that look like when you take it to the portfolio?
Yeah, so at Thornburg, we're fundamental investors. We're investing in companies, not in countries. And, so we're really looking at what are the fundamentals of the businesses and how does that change in these different scenarios. We're growth investors. We want to have a diversified portfolio. We talk about investing in diversified sources of growth. And we really want to be invested in companies that are in control of their own destiny. So Shopify is a perfect example of that this morning, doing really well. They beat on the top line. The market wanted 20%. They gave them 26%. 19% free cash flow margin. You're seeing them beat both on the top line and on the bottom line. And the reason that we really like a company like Shopify is because they're in control of their own destiny. They're gaining share through a better product, through execution. They're taking share from sleepy incumbents, and they're in a structurally growing market. So when we think about how we want to invest, those are the types of businesses we want to be focused on.
Shopify is an interesting one. We were talking about Home Depot a little earlier as well. This whole idea that the consumer is strong. But before we got into this moment, we were talking about how the consumer was weakening. The labor market was weakening. That credit card debt is at all-time highs. Does that all matter anymore when you're thinking about
I think it does matter. I think it absolutely matters. I mean, if you think about what has changed from last week to today, you still had a 500 basis point rate increase for the last 2.5 years. That, it's a long and variable lag for that to come through. You have savings that are down. You have consumer credit card debt that's high. That's why we maintain a pretty cautious stance. Now, a company like Shopify, I think what we like about it is they can grow sort of regardless of the consumer environment. They're going to deliver earnings power above what the market expects, whether the consumer is really strong or whether it's not. And I think actually the risks to inflation going higher from a new administration, at least from some of the early signs that we see, are pretty high. So I think we should be very vigilant around that.
What are you doing in your fund? I'm looking at the net asset value, and I see it going from 25 to 27. this year, while the S&P has just taken off. We're up, what, 26%? What's the problem there?
Well, we're an international growth fund, so we're looking at companies outside of the United States. And, the U.S. has seen, a combination of relatively strong earnings growth and also very significant multiple appreciation. So, we're now at 22 times forward earnings. And if you look outside of the U.S., we're at a pretty historic discount. And so
it seems weird to me to even say growth outside the U.S. Growth is in the U.S., right?
Growth is in the U.S., but again, we're investing in companies, right? So we're investing in strong, high-quality leading businesses that we think are exposed to these incredible secular growth trends. They've taken a little bit of a step back, a little bit of a breather, but none of this is going to be linear. AI is still an area that we're really focused on doing deep fundamental research on. We think that the businesses that we're invested in, which, by the way, is an incredibly global supply chain, these are going to be long-term winners. Their earnings power is not being priced in by the market right now. We see this as a huge...
But what are the other names? Shopify, as we've been talking about today, is outside the U.S. It's in Canada.
Yeah, it's a Canadian business.
What else? What else are the names that we would know?
Sure. So TSMC, Novo Nordisk, Nubank in Latin America, an incredible, fintech in Latin America that really doesn't get talked about that much. It's up almost 90% in dollar terms year to date. So, that's the beauty of being an active manager is we get to look around across the world and find these areas of mispricing where the earnings gap, between what the market expects and what we think and what the market wants to pay for is just really significantly discounted. And these are some incredible businesses that are generating really long-term returns. And in the end, that's what's going to drive market prices.
So you mentioned TSMC. I see AMD in your notes as well. When you're thinking about the AI story and that investing narrative, how are you weighing investing in the picks and shovels versus the end users of AI? Where are you on that narrative?
We're really focused on the picks and shovels still. We think, so if I think of the picks and shovels as the semiconductor business and then the cloud service providers, is sort of like the two layers of the picks and shovels. That's really where we want to be focused still, the foundational models. And then the application layer on top of that, I think, is still really too early to tell. But in every instance, we see the semiconductor industry and the cloud service providers really being winners in this long-term platform shift to AI. And so that's where we want to be focused. The barriers to entry are incredibly high. The laws to scale continue to grow. I mean, Larry Ellison's talking about $100 billion to build a foundational model in 2026 that's competitive. We continue to see cloud service providers. It's huge.
Massive.
And we continue to see that CapEx grow. And the interesting thing about it, too, is you're not only seeing the CapEx grow, but you're seeing utilization levels remain very high. So we think that this is sustainable investment that's paying off in returns to shareholders already right now.
Emily, we've got to leave it there, but we are looking forward to talking more about that AI trade as the dust settles on these election trades. That is Emily Leveille of Thornburg. We're going to get a look at stocks now. Moving this hour, we're going to bring in Bloomberg's Abigail Doolittle.
Let's start out with the shares of Meta, Sonali, because they are higher, up 1.4%. In fact, earlier they had been up more than 2%. It's interesting because the news that seems to be happening or is happening amid this move for Meta could potentially be a hit to the revenue. Essentially, they've made a concession to the EU. Instagram and Facebook users in the European Union will have the option to check off the not personalized ads. And again, that could hit revenue, but investors seem to like the concession. Turning to the shares of Honeywell, Elliott, of course, is taking a $5 billion stake. They're calling for a breakup of the company into two standalone units. Aerospace and automation, investors clearly liking this, as we've seen a number of these conglomerates come apart. And then finally, speaking about coming apart, not really in a big way, but that Trump trade taking a little bit of a breather today. A piece of this, of course, Katie, is Tesla, which into today had been up more than 30% over the last 5 days. CEO Elon Musk, a big part of the campaign, and I think everyone's waiting to see what, if any, official role he takes in that administration and what benefits there could be to Tesla around the cyber robotaxi, not to mention AI.
Yeah, a lot of big questions there about who will staff, of course, the Trump administration. Abigail Doolittle, thank you so much. Now, coming up, bad weather is good news for Home Depot. We'll discuss the latest earnings from the DIY giant next with Joe Feldman, Telsey Senior Research Analyst. This is Bloomberg.
Let's get now to high interest. Look at what's making headlines around the world. German Chancellor Olaf Scholz's Social Democrats and opposition lawmakers agreed to hold a federal election on February 23rd. That's 7 months earlier than scheduled. Scholz will need to trigger the national ballot by first submitting to a confidence vote that will come next month. Howard Lutnick is raising his hand to run President-elect Donald Trump's economy. The Cantor Fitzgerald CEO co-chaired Trump's campaign for re-election and spoke of sorting out the government's $2 trillion deficit along with Trump and Tesla CEO Elon Musk once they won the vote. He and Musk say they're ready to gut federal agencies, disband entire departments, and stock the vast bureaucracy with loyalists like themselves to unleash American capitalism. And Wall Street bonuses are expected to climb across all sectors in the industry for the first time in 3 years. That's according to a new report from compensation consultant Johnson Associates. Investment bankers, traders, and asset and wealth management professionals are all set for double-digit increases in year-end incentive pay. Bankers who help companies sell debt might realize the biggest gains, with payouts set to rise as much as 35%. Katie?
All right, let's focus back in on shares of Home Depot. They were higher this morning. Of course, they raised their forecast for the year, but shares a little bit lower right now, even though the company saw increased demand for home improvement due to bad weather. Joining us now straight from the earnings call, I'm pleased to say we have Joe Feldman. He is Telsey Senior Research Analyst and Assistant Director of Research. Joe has an outperform rating on Home Depot with a $455 price target. It's interesting to see this reaction. Much, of course, has been made that you had hurricane-fueled demand. Could that fact explain why we're seeing the stock flip right now? Because that's not exactly sustainable or something that you can forecast, Joe.
Yeah, I think that was a big part of it. You know, the weather was a big help in the quarter. That helped underlying trends, but then the hurricanes was that little extra boost. But even if you remove the hurricane, they did a better than expected quarter. I mean, the comp would have been down like 1.8 instead of 1.3. So would have been very good sales overall. I think the concern is what happens go forward. You know, we have the fourth quarter is started off warmer than normal in many parts of the country. So that's not necessarily the best thing you want. You kind of want colder weather to set in to help that seasonal side of things. I think the other part of it is that the macro from a housing perspective is not getting that much better. So at least not yet. So I think that that's why some investors, if you're bearish on the stock, you heard enough good things there today. If you're bullish on the stock, you definitely heard a few things that would give you some hope. So I think it's both sides of it came out this morning.
What happens, Joe, if you don't see mortgage rates drop below 6% soon?
You know, it's interesting. So on the earnings call, and this makes sense to me, Home Depot had talked about the fact that you kind of just need stabilization. I do think you want to see, you know, mortgage rates drop a little bit more. But if we did see some stabilization and people stop thinking, well, it's going to drop to 5 or it's going to drop below 6, whatever it might be, or around 6, and think, okay, 6.5 or so, maybe the rate, and that's what I'm going to have to live with, that could actually get some people off the couch to start to do some activity and maybe have some turnover there.
What about the actual housing market in terms of, you know, previously owned homes changing hands? It hasn't been happening for a long time. Do you see anything moving that in, for example, the incoming administration?
Well, it'll be interesting to see how it plays out. There's definitely feels, if you look at the stock market, there's definitely a little bit more life, and people are feeling like with potential deregulation and other maybe tax cuts, that could help some things and maybe free up some movement and activity. I do think that if people felt a little bit better about interest rates, they would finance bigger projects and maybe get engaged more. You know, Home Depot and Lowe's relies on housing market turnover, but for the most part, it's really people staying in their homes, taking on projects, doing activity while they're there. And so we really want to see that start to happen.
And speaking about the new administration, I want to talk to you about tariffs, of course. When it comes to this group of companies that you cover, you think about some of the tariff levels that we're talking about once Donald Trump returns to office. How does that impact a Home Depot? I know that, again, they source most of their materials from the U.S., but how do you think about that as you evaluate these companies?
Yeah, it's absolutely a factor in what we're thinking about these days. And, even the day that Trump was elected, if you go back and look back to Wednesday of last week, you saw that trade activity. Companies like Floor & Decor, one of the ones I cover that has a lot of exposure to international direct imports, you saw pressure there. You saw pressure on the dollar stores, on Five Below, some of those types of names. And so, as you said, Home Depot does source a majority of what they buy from the U.S. and domestically, but I do think there's going to be pressure. Every retailer we've spoken to in the past week or two or several weeks anticipating the election has said they'll work with the vendors. They'll try to use operating efficiencies to lower some of the costs. But at the end of the day, some of it's going to get passed through to the consumer. And they all said that they're going to have to pass through some of that.
Well, to that end, there's kind of a derivative effect there, isn't there, Joe? And if you're sitting there trying to put a price target on what happens next year to these companies, even if they don't source a lot of their goods internationally, you have a company heavily exposed here to the U.S. consumer who might feel prices rise. According to Isaac Boltansky, for example, he believes in his research that this is another $2,600 per year per family. And so if you're struggling with those kinds of costs potentially next year, then what does it mean for a company like Home Depot?
So it's definitely going to pressure the consumer in my mind. I think that, we're very concerned about everything you just described, that you're going to see inflationary pressure on the consumer if these big tariffs get put in place, because it's going to have to flow through. So I think from an investment standpoint, you probably want to play it somewhat defensive, like a Walmart or a Costco, where they sell mostly food and it comes domestically. But from a Home Depot and Lowe's perspective, the one interesting factor here is 90% of their customers are homeowners. Homeowners, by definition, tend to be a bit more affluent. They probably have a little more ability to sustain those increases, but absolutely, it's going to put pressure. And depending where interest rates are in that environment, what happens from a tax perspective, I think it's going to put more confusion into the market, and it probably, keeps people from doing big ticket projects a little longer. That will hold off on doing that, and that's not great for Home Depot and Lowe's. We'd like to see things get better there, but absolutely, that pressure on the consumer is likely to be very real.
Joe, do you see any inflation or deflation in Home Depot's goods? I was at Costco yesterday, and I noticed that they've raised prices of their baby formula by more than 10% in the last 2 weeks. It's already the cheapest in America. But do you see, the average ticket price rising there for reasons other than people spending more money? I mean, are they raising prices?
Home Depot is not raising prices as of yet. And I think that that's an important factor. And to your point earlier about direct importing and how much of the goods come from outside the U.S., that will have an impact on how much prices may or may not have to go up. And I do think that you will see incremental pricing pressure from from imports. What's interesting also on the food side of things, I know everybody's frustrated. Food prices are still high on a relative basis to where we were a few years ago. A lot of it is also, it's just the commodity prices. I mean, like egg prices are way up. It's driving everybody nuts. There was avian flu in the flocks this year. So I think you had to reduce some of the amount of eggs that are available. So it is more of a supply demand thing. It's not just all these other pressures, but collectively we are seeing and expecting to see a little bit more inflation, pressure next year, especially if the tariffs go into effect.
All right, Joe, great to get some time with you. Really appreciate your perspective. That is Joe Feldman of Telsey. And on that conversation, an interesting story that just crossed: Stanley Black & Decker weighing price hikes ahead of Trump's tariffs. This according to a filing. The toolmaker is preparing for increased tariffs very soon. As such, it's assessing its supply chain adjustments to mitigate those effects, also considering higher prices. It's going to be interesting to see how many companies are as well. But still ahead, Mattel's new Wicked doll line sends customers to a porn site. We'll have the details on the flub next. This is Bloomberg. All right, it's time now for Social Climbers, the companies making waves this morning. And first up, Live Nation saw its biggest summer concert season to date in announcing its third quarter earnings. One analyst saying that the incoming Trump administration may look to settle the Ticketmaster lawsuit rather than seek a breakup of the company. Shares a little bit higher. Next up, Costco reportedly removing about 80,000 pounds of butter from its shelves because the label failed to mention that it contains milk. The FDA sent out the recall of Kirkland's signature butter because of the undeclared allergen last month. And this move has garnered ridicule online, with one user posting on X, quote, "In other news, ice is made from water." And finally, we have Mattel apologizing for printing an incorrect web link on packaging for dolls tied to the Wicked film. The link led to a porn website instead of the official website for the upcoming movie. And Mattel didn't say how many toys were affected, but it did say that customers should discard the packaging or obscure the web address before giving it to children. News you can use there. Let's get to these markets right now, of course. About an hour into the trading day, the S&P 500 has flipped back to negative territory. Same, too, if you take a look at the NASDAQ 100. The bond market selling off as well, so a little bit of a cooling off. Now, coming up, cybersecurity giant Check Point, the CEO, joins us next. This is Bloomberg.
Check Point is set to reveal its latest security innovations. Next week, it will be revealing 50 new capabilities for its customers, all powered by artificial intelligence. The innovations come as the company saw a 75% jump in cyber attacks per organization as compared to last year. And of course, for the consumer, identity theft is one of the biggest problems really facing this country. Joining us now is Gil Shwed, Check Point CEO. And I say country, it's a global problem. Scams are taking tens of billions of dollars away from people now every year, Gil. How hard is the fight against these thieves?
First, glad to be here, and the challenge is a very big challenge. We are now facing what we call the fifth generation of cyber attacks. These attacks are not just more attack, not just 75% increase in the number of attacks, but much more sophisticated attacks that are hard to detect, hard to defend, and are much stronger. I think we're standing well in that fight. I think we make every day the world secure, but it's not an easy challenge.
You know, it's interesting when you take a look at the information, the data coming in about where these attacks are headed towards. The government is a big part of this, and you spoke to investors recently talking about your recent work with the U.S. Department of State. When you think about the world right now, how dangerous it is in so many ways, how do you see the contracts with governments, particularly the United States, taking higher?
I think all the governments in the world, it's a high priority on their list. We are adding many government agencies every quarter. It's dozens of government agencies all over the world. I think last quarter it was like 55 countries. And that's very important. And government is a big target, both because there are a lot of organizations with the motivation, and also in some part, not in the US, by the way, depends on the level of defense. If organizations that are being attacked are usually organizations that are that defend themselves less.
And keeping the conversation on government, of course, Trump coming back to the White House. I'm curious what you're thinking about M&A. The thinking out there is that deal making is going to be back in a big way. I'm wondering what that means for you, what that means for Check Point potentially.
I think in general, we will see more deals in the cybersecurity space because there is way too many companies. There's tons of great technologies, but the customer cannot absorb thousands of cyber technologies, and we will see consolidation. That's something that will happen. And we hope to be in the part that makes our platform stronger and bigger, partly through acquisitions.
So what kind of companies have you got your eye on, Gil? Can you tell us, the enterprises that you're looking at, or the size of companies that you would be interested in?
First, we are not planning any major acquisition for the foreseeable future. I don't want to raise expectation. We do see a lot of small technologies that augment our platform on the network side, on the cloud side, on many other places. We just completed a very important acquisition in the field of cyber intelligence, when we can actually scan the company assets and tell you that you're not you as a person, but as a company, that an identity of an employee has been stolen, and therefore this employee needs to change his password or tighten the account because that's a hole in the organization. So then, of course, there's much more that this company does. So this is an example of very creative, I think, acquisition that we made that strengthened the platform. And what we want to do is that the platform will react automatically. When we identify this threat, we automatically shut down the vulnerability.
Gil, I'd love for you to talk about the future of the company a little bit too, because of course you're going through a management transition, pretty recently announced for what it's worth. What is going to be the biggest difference in Check Point moving forward?
So we announced that I'll be transitioning into an executive chairman, and we have a new CEO, which is an amazing talent, I think, in our field, expert, more than 10 years in our field of cyber, and one of the more known figures. And I think I think Check Point is a great company. So the infrastructure that we built, will continue. I think we will become more aggressive on everything we do, and I hope that will bring up a lot of new energy, a little bit inside and much more outside going, and providing our technology to more customers around the world.
I'd love to talk about the competitive landscape a little bit. For example, you think about the CrowdStrike outage just a couple months ago that seemingly crippled everyone for about a day or so. Did you benefit from that at all?
I don't think that we benefited. First, we are not in the endpoint space, and also I don't think that we're in the business of celebrating someone else's misfortune. I do think that it raised the entire world eyes into the importance of having good software. And by the way, what a cyber attack can do, because what's happened here was a software bug that shouldn't happen, but it could have easily been an attack. And by the way, it could have easily been a software bug, not just in cyber software. It could have been an easy bug in every type of software that could create that kind of damage to the world. So, I mean, our dependency on computing, on IT, and on challenges with that, whether it's cyber attacks or bug, is huge. It's not a bad thing. We know how much we benefit from technology, but we need to make sure we tighten the security so a cyber attack won't create the same damage.
Gil, we've been talking about, Howard Lutnick and Elon Musk want to cut spending out of the U.S. budget, but cyber security is a huge issue that we may need to spend more money on. Do you have any recommendations to the Trump administration in terms of managing the cybersecurity risks that we face as a nation?
I don't know if I can recommend to the administration much, but I think that the general rules are very simple. It's not just about spending more. I think the world is a world we need to invest in cyber, but it's not just about more spending. It's doing it smarter. It's building consolidated architecture, just like our defense forces are not operating independently. We need to make sure that all the cyber forces are working together. And what I mean in that, a company today, an enterprise in America, and a big company can have anywhere between 12 to 50 and sometimes even hundreds of different cybersecurity tools. Today, they almost don't work together. We need to make sure they will work together. As I mentioned in the beginning, part of it would be consolidation, but part of it would just be making all our security tools working as one platform, defending us, preventing the attackers from getting in. And that's true in the government, and that's true in any enterprise in the world.
All right, Gil, got to leave it there. Appreciate you taking the time. That is Gil Shwed of Check Point. Meanwhile, an hour into this trading day, let's get a check on these markets with Bloomberg's Abigail Doolittle.
Right now, we're looking at a small decline for the S&P 500. This would be the first, really, since last Monday, if it holds. The day is still young, though, so let's see. Bitcoin also down, but off of its lows, closer to $87,000 per Bitcoin at this point, down less than 1%. It's going to be interesting to see whether or not the Bitcoin buyers turn that small loss at this point around to a gain, given the massive gains since the presidential election. We have yields higher, and then we have oil up just a little bit. So some pieces of the Trump trade working here, others are not. Let's check in on the S&P 500, because on the election, the S&P 500 technically did something very interesting. You can see here is the index over the last 6 months, and there's a pretty nice uptrend here, sort of similar to the 200-day moving average. But right before the election, we had a gap below that uptrend. What should have happened is a continued decline, especially since at that point the RSI, or the momentum, was going down. Instead, on the election of Donald Trump, the index did the quote-unquote impossible and gap back higher. The question is, that's a weakening uptrend. When would we potentially see some more of that weakness take place, or are we going to go higher before the weakness? Long story short, because the uptrend did start to weaken, at some point we're going to see a bit of an unraveling around this, and that RSI just at a 69 butts.
But Abigail, so it looks like then fundamentals triumphed over technicals?
So that's the technicals, I would say, are generally ahead of the fundamentals. But in this case, yes, that gap does tell you that investors were really surprised. And in some ways, yes, I guess that is a way to put it, that the fundamentals, the news, did take out the technicals. Doesn't happen very often, but a bearish reverse, or excuse me, an island reversal gap like that is one signifier. However, there is, again, the message that that uptrend may be starting to weaken. And then finally, beneath the surface of the S&P 500, and thanks for the question, Matt. It's always fun to do live charting. Home Depot had been higher after they beat estimates. They raised the outlook. Apparently, there's color coming out saying that home remodeling is a little bit weaker because of interest rates. The stock down. NVIDIA helping out the index, up 2.6%. Micron, on the other hand, Edgewater putting out some research about DRAM and NAND pricing. That's not helping those shares. And then Mosaic, down 6.5%, a little bit of a rough quarter. Those results weighing on that stock. So here are some of the bigger movers beneath a relatively benign surface, Sonali.
We are still ankle deep in earnings season, that's for sure. Abigail Doolittle, we thank you so very much for taking a look under the hood. Nobody does charts like Abigail. Now, coming up, we're going to talk about investment performance. Research Affiliates Chairman and partner Rob Arnott discusses the difference between alpha and beta and where you can find it. This is Bloomberg.
All right, it's time now for our daily Wall Street Week conversation. And today the spotlight is on Rob Arnott. He is the chairman of Smart Beta Pioneer Research Affiliates. David Weston spoke with Arnott about how to measure an asset's performance.
Beta really just measures how much a strategy or a stock moves when the market moves. In other words, if the market's up 10% and a stock is up 10%, give or take some random noise, it has a beta of 1. If it's up 20% plus or minus some noise, it's got a beta of 2. And alpha is the performance of the stock relative to that sensitivity to market movements. So this was pioneered by Bill Sharp in 1964 in his Nobel Prize winning paper that invented the capital asset pricing model. And the goal is to earn positive alpha, not negative, and to have beta that reflects your risk tolerance. So higher beta if you're more risk tolerant, lower beta if you're less risk tolerant, as most of us are.
Is it overly simplistic to say that really alpha has to do with beating the market?
That's a very mild oversimplification. That is the essence of alpha. People talk about wanting alpha. No, you want positive alpha. Alpha is positive or negative. There's always alpha, and you want positive alpha.
There has been a move in some circles for some part of a diversified portfolio to really go more into index funds and really betting on the market at a lower fee. But apart from going straight to beta, there's something called smart beta. Tell us about smart beta. What does that mean?
Sure. The term smart beta was coined by a consulting firm called Towers Watson in 2007. The inspiration for it was fundamental index, which was our idea back in 2004. Fundamental index simply says, why should we weight stocks according to how popular, beloved, and expensive they are? Why not weight stocks according to how big they are in the economy? Now, what that does is several things. Firstly, if a stock is a growth stock priced at a premium multiple, it reweights it down. If it's a value stock priced at a deep discount, it reweights it up. That's not because these aren't good companies and these aren't troubled companies. That's because the good news is already in the price. The bad news is already in the price, so it's harmless to reweight it. Now, the other thing that Fundamental Index does is to introduce a rebalancing alpha. If the price rises and the fundamentals don't, thank you for the gain, we're going to reweight you back down. If the price tanks and the fundamentals don't, we're going to say thanks for the deep discount.
And that, of course, is Rob Arnott speaking with David Weston, who joins us at the desk now. Rob Arnott is the godfather of smart beta. That's how he's known in investing circles. Really interesting to hear it from the horse's mouth, what he actually considers smart beta to be.
Well, you had him on yesterday, actually, talking about what happens in light of the Trump election. But we wanted to go back to first principles. You all know this stuff, but it helps me to go back to first principles and understand exactly what is alpha, what is beta, and what is smart beta that, as you say, really he pioneered. And one of the things that was interesting to me is, as you heard, in general, growth gets disadvantaged in smart beta and value gets advantaged, which means that in recent years, it's been disadvantaged and funds have flown out of smart beta, actually, as growth has taken off. But he thinks that is now correcting.
You know, the first time I really heard anything from Scott Bessent was in a sit-down interview with you. I'm sure Sonali has been following his career for a long time, but that raised my awareness on Wall Street Week. And now we're talking about him as the favorite to run the Treasury. What do you think we could see from Scott Bessent if he is indeed named Treasury Secretary?
First of all, my impression with the Trump administration is it comes from Trump. First and foremost, he will decide what gets done, what doesn't. I can tell you what he has told us, told me, which is number one, President Trump is very concerned about the debt and deficit. You might think that's not true. He swears that he really is very concerned about that. He thinks he can address it by some real cost savings, including with the IRA because of all those income tax credits. Eliminating those will make a lot of money, and also some Medicaid revisions. He also, on tariffs, I mean, he does not deny the potential inflationary effect of tariffs, but he really says you have to take that as a positioning by President Trump to get people to the negotiating table to actually negotiate off of those. That's at least what he said to me and to us.
Well, I want to even double down on this because according to the Wall Street Journal, John Paulson is dropping out of the running for Treasury Secretary. Listen, the betting odds, the poly market odds have already been in Scott Bessent's favor. And to your point here, Trump makes his own decisions. Key advisors have been putting forward Scott Bessent. Bessent actually was one of the key men behind the Economic Club of New York speech as well. So very involved early on. What is he saying? What is he putting out there, and how are people latching on to it?
Well, one of the things that I believe is he has been advising Donald Trump personally for quite a while. I mean, talking to him, if not daily, pretty close to daily. And I'll just to editorialize a little bit, which I shouldn't do. Someone like Scott Bessent, whether it's him or not, I take some encouragement from him because he knows the markets. He knows Wall Street. And one of the things I think we have to at least anticipate the possibility of is a debt crisis. And if you have a debt crisis, you need somebody like a Hank Paulson or a Tim Geithner or a Bob Rubin who knows the street, who has credibility. And we know because Scott Bessent's experience with Soros and with Stan Druckenmiller, he knows the markets. And it just may be you need somebody who understands the markets really well, the plumbing of it, depending on what happens over the next 4 years.
Well, David, just quickly here, to that point that he knows the markets, Bloomberg has reported that's one of the reasons why advisors have told Trump he would be good for the job. We know that Bessent recently wrote an op-ed in the Wall Street Journal talking about how markets have embraced Trump and his potential policies here, but markets are fickle. I mean, that could turn pretty quickly.
And so is Trump.
Yeah, that's true.
There's no question about it, without a doubt. But we had this experience to some extent, didn't we, in 2016, when everybody thought it was all going to fall apart, and it didn't. And listen, I'll call it reversion to the mean. We have a tendency, particularly in the media, to go to extremes one way or the other, and sometimes the markets do too. It tends to come back towards center. And I think if Scott Bessent were here, he would sort of suggest some version of that. That looks at they're going to make real changes, make a real difference. He thinks good difference for the better, but you don't want to go too extreme with any of this.
All right, David, really appreciate your great perspective as always. That is David Weston, and you can catch Wall Street Week every Friday at 6 p.m. Eastern. This is Bloomberg.
As Donald Trump continues his cabinet appointments, one Wall Street billionaire is raising his hand to lead the economy for the next administration. Cantor Fitzgerald head Howard Lutnick has been serving as co-chair of Trump's transition team, and many suspect his own name is on the list for potential Treasury Secretary, although there are a few names on that list. Of course, we've been talking about it. But joining us now is Bloomberg U.S. finance reporter Todd Gillespie. I'm very sorry, Todd. The fascination here is how quickly he came not only into Trump's graces, but the influence he's had. There's been a lot of conversation about his persona and how it fits into Washington. What do you think he's going to be most effective at getting done? He's made a lot of big statements.
Totally, Shwed. I mean, this is a man who a year ago was a complete political novice. You know, no one outside of Wall Street really knew who he was. Even in Wall Street, he was considered largely an outsider, a man who ran a brokerage, was not a white shoe banker from Goldman Sachs or Morgan Stanley. And now he's really, through sheer force of personality, kind of elevated himself to the top of DC. He's the first man that a lot of executives and politicians are calling up after the election, trying to get their names, trying to get their allies' names on these lists for the cabinet. He's a man who really is, you know, he's bombastic. He is really one of these people who's in for creative destruction. He's up for tearing down departments, and he thinks he can really bring in the private sector to really move along this Washington bureaucracy and align himself with these, you know, really transformative energy that we're trying to see, you know, that we're starting to see under a Trump administration.
So isn't, though, Scott Bessent really favored to be Treasury Secretary? I mean, if I look at the betting markets, he's heavily favored. And I know we're saying Lutnick is raising his hand, but doesn't Donald Trump want, you know, someone who is viewed as, you know, one of those Wall Street insiders to be doing this job?
Totally. I mean, we're reporting today, right, the Trump advisors have said that Scott Bessent is increasingly potentially a favorite to be Treasury Secretary. Lutnick could serve in another role, like a special government employee or some other kind of economic advisor. And you're right in bringing up Scott Bessent here, because in some ways the men couldn't be more different. You look at Bessent's op-ed the day after the elections, you know, calmly articulated, talking about how the markets had reacted positively to Trump. You look by...
I mean, that was a love letter to Trump.
Right, sure.
that was like, hey, still love me.
Yeah.
Right?
I mean, Lutnick expresses his love in different ways, partly by going on 2-hour podcasts with, you know, cryptocurrency investors and, you know, spieling off, you know, all of, and indeed coming on Bloomberg TV and talking about the kinds of policies that he wants to see, very unapologetic in his style, you know, in terms of talking about Donald Trump.
Well, we'll have to see how it all shakes out. Really appreciate your reporting. Of course, that is Todd Gillespie of Bloomberg News. And let's go check on these markets right now. The S&P 500 in the red. This would snap 5 straight days of gains for the S&P 500. But as Matt said a while ago, it feels like at the market open, a lot can happen between now and 4 p.m. You take a look at the NASDAQ 100, though, your big tech names also lower at the index level. Your yields rising right now. The bond market is open, and that sell-off is resuming on the 10-year Treasury yield. We are knocking on the door of 440. Yields up about 8-9 basis points right now, Matt.
All right, coming up tomorrow on Open Interest, our lineup includes Mike Novogratz from Galaxy. I'm excited to talk to him, as well as Brent Schutte from Northwestern Mutual and Sarah Wolf at Morgan Stanley on the markets. This is Bloomberg.